Hello and welcome to the Business Standard Morning Show. I'm Venu Sandhu. Let's take a look at the stories for the day.
What the world needs now is people who see healthcare a little bit differently. Because seeing a healthier world isn't far in the future. We're building it now. GE, building a world that works.
Shares of state-owned Life Insurance Corporation of India kickstarted their journey at secondary markets on a weak note on Tuesday. Against the IPO price of 949 rupees a piece, they opened at 867 rupees on the BSE, wiping off nearly rupees 43,000 crore worth of investor wealth. While analysts are upbeat with the stock performance, the government may have more to worry about than just the LIC's stock. Our next report takes a deep dive into what LIC's weak debut means for this year's disinvestment target.
India's insurance Goliath Life Insurance Corporation of India proved to be non-profitable for all categories of investors as its shares fizzled out on the bourses yesterday. Against expectations of a marginally lower listing, shares of LIC debuted on the BSE at 867 rupees, down nearly 9% against its issue price of 949 rupees. They further fell to a low of 860 before settling the day at 875 rupees apiece. With this, LIC's market cap stood at 5.53 trillion rupees at the end of its debut day. This means investors lost roughly 47,000 crore rupees in the IPO, which valued LIC at 6 trillion rupees. However, investors are unperturbed by the muted debut as they eye LIC's long-term growth prospects.
LIC is a long-term play in the insurance sector, and investors should not look at listing gains alone. Any opportunity to add to LIC at a price lower than the IPO price should be used to invest more for the long term. There may be a bit of retail selling. The long-term fundamentals of LIC remain intact. Once the dust settles on the market due to the ongoing issues like Ukraine-Russia war and the worries on the inflation front, stocks in the insurance sector, along with other beaten down stocks in the banking and NBFC space, should see good momentum.
B. Gopkumar of Axis Securities too opines that investors should not exit LIC's stock at current levels as it is a play on the growth story of the under-penetrated life insurance industry. LIC's sustained market leadership position, robust pan-India distribution network, and shifted focus towards profitable products will support margins and improve persistency ratios. All these factors will collectively make LIC an attractive pick from a long-term perspective. However, there's more to LIC's listing than what meets the eyes. Funds from IPO will be critical to bolstering government finances and meeting a deficit target of 6.4% of gross domestic product for FY23. LIC's IPO was already slashed by almost 50% to ride the market volatility, and still a tepid response to one of the most well-connected state-owned entities may prompt the government to rethink its divestment strategy.
The fact of the matter is that they have sold only 3.5%. So this gives them a currency to raise money when they want through OFS, offer for sale. So that is what I think they really wanted in terms of listing, so that they have a currency which they can encash as and when they want. And of course they have another 96.5% of the company left, so they can easily sell it when the market performs. As regards other divestments, well, of course, some of the divestments there are some issues, like say for example BPCL. I think it's too complicated. There are too many subsidiaries, too many other considerations. So therefore, just cleaning it up for readying it for sale to private parties who probably just want a pure refinery and distribution play, and not all the other stuff that goes along with that. So I think that is probably taking time, and it is as a composite sort of offering. Maybe they were unable to generate enough interest through BPCL as it is, but they will have to sort of clean it up and ensure that they offer what the market wants, what the entrepreneur wants. So whenever that happens, I think there will still be a demand for that. It is not as if the refinery business is going out of fashion anytime soon. So there will be a lot of demand for that.
According to a Reuters report, the government is considering inviting bids for a 20% to 25% stake in Bharat Petroleum Corporation instead of an outright sale of its entire 52.98%. Similarly, it will likely put on hold the sale of state-owned helicopter service provider Pawan Hans indefinitely, as per a Business Standard report. The centre has missed its revised divestment target twice in 3 years. Now, achievement of this year's target looks difficult too, which assumed the completion of the process to privatize BPCL and SCI amid a market drought due to the spillover effects of the ongoing war. Against this backdrop, Bhatt expects the government to receive decent market proceeds from various stake sales as and when market conditions stabilize and the government reworks bid offers as per investors' interest. On Wednesday, investors will eye any rebound in LIC shares. Besides, they will also track March quarter results and global cues for further market direction.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The weak listing has brought down the market valuation of LIC to around rupees 5.57 lakh crore from the earlier 6 lakh crore. Unstable market conditions is one reason for this. Meanwhile, FMCG companies too are struggling. They have now resorted to shrinkflation to cope with the increased input cost without passing on the price burden to consumers. The low-cost packets of biscuits, chips, juices, soap, etc. have shed weight. And so the same 10 rupee packet of chips will have fewer chips and more air. This report has more on shrinkflation.
Just as consumers are trying to manage their budgets in the current high inflationary environment, FMCG companies too are resorting to both time-tested and innovative ways to mitigate the unprecedented input cost rise. Companies are going for a mix of both direct price hikes and grammage cuts. Raw materials like edible oils, wheat, crude oil derivatives, laminates and corrugated boxes that go into making biscuits, soaps, cosmetics and detergents have been on an upswing since the second half of FY21, with geopolitical factors aggravating the inflation. The wholesale food price index inched up to 8.88% in April from 8.71% in March. And Hindustan Unilever CFO Ritesh Tiwari recently said that reducing the volume in certain price point packs is the only way for us to take price increases. The 10 rupee bar of the company's Vim soap weighs 135 grams now, compared with 155 grams about 3 months ago, Bloomberg reported. At the same price point, a pack of the crunchy aloo bhujia made by Haldiram's is 42 grams now, down from 55 grams. Making the product smaller while still maintaining the same price is termed shrinkflation.
So price rise can be addressed by brands in typically 3 ways, right? Increasing the price of the product directly. The other route that they take is reducing the grammage, especially when they do this when the price point is established. When I say established price point, it could be a 5 rupee price point, it could be a 10 rupee price point, it could be even a 20 rupee price point. The lower the price point, the more they play on the price point itself. The third route that all of these guys use to address is maybe they just change the formulation a little bit. They change the ingredients. Now, with the grammage piece, we are seeing a lot of changes happening in the lower price points. At the higher price point, you will see an increase in price being passed on directly. And that's what's been happening in the market. The good news is that competitive pressures are keeping them at the same price point right now. Had there been no competitive pressure, this would have changed very, very quickly. But now that we are actually stuck in the middle of such high inflation and competitive pressure both, it's a balancing act. And at the same time, you're also balancing investors on the other side, because you have to now maintain profitability also. So all of this essentially comes, and this balancing act is grammage cut, is what one of the routes that they take in this space.
Akshay D'Souza of retail intelligence platform Bizon also says that when a company is very heavily exposed in terms of revenue to certain price points, tinkering with them is a competitive risk that could result in loss of market share. He said that for many in India, a tea and a small biscuit pack doubles up as their meal. Dabur India CEO Mohit Malhotra has called the rupees 1, 5 and 10 as sacred price points, whereas HUL's Ritesh Tiwari referred to these as magic price points. Taking a look at how much low unit packs contribute to the sales of some of the top FMCG companies will give a sense of how important these price points are for them in India. HUL gets almost 30% of its business from rupees 1, 5 and 10 packs. For Britannia, this moves up to 50 to 55%, and Parle Products, which makes Parle G and hide and seek biscuits, derives a massive 70% of its revenue and volumes from 10 rupee packs and below.
Whenever there is inflation or a sudden rise in input costs, the way to go is definitely try and absorb as much as possible. Then we talk about price increase. There are two ways how you can increase the price. So for particularly in our industry, I'm talking about salty snacks, biscuits, bakery, where the price points are extremely critical. So 10 rupee price point and below, we do not touch the price points. So we go for weight reduction. Beyond 10 rupees, we tend to increase the price beyond 10, and now actually slowly 10 also, even 20 rupee price point is becoming little sensitive. But beyond 20 rupees, consumer is fine to look at a price increase of, even if it is 22 rupees, a consumer is fine. So there we take direct price increase. So across our portfolio, in the past, let's say 12 to 14 months, we've taken a price increase roughly to the tune of about 7 to 8%. There is a lot at stake. There is a lot of market. There are certain pockets and certain markets where we get a significant contribution from these packs. So we cannot actually overnight just stop these packs. It could come at a slight cost in terms of compromise on profitability. I think 2025 is when, by 2025 is when I believe the 10 will be the new 5. Today's 5.
Britannia Industries MD Varun Berry recently said that low unit price points in a country like India are impossible to vacate, given it has a lot of bottom of the pyramid consumers. It is for this reason that companies go to lengths to protect lower price points, even at the cost of profitability.
See, low unit price points in a country like India are impossible to vacate. Yes, over the years, if you look at it, maybe 15 years ago, there used to be a large contribution of 2 rupee and 3 rupee packs, which have become minuscule today. Parle used to sell a lot of 2 rupee and 3 rupee packs. We also used to have a reasonable contribution of 2 rupee, 3 rupee. It's all migrated to 5 and 10 and thereafter. So I don't think we are in any position to vacate the 5 rupee segment at this point in time. But as the world evolves, as the consumer evolves, and as we get through all of this inflation, time will tell when is the time to really press the pedal on 10 and move on from 5. But I don't think we are in any position to do that right now. It's about the price point packs. The 5 and 10 are approximately 55% of our total mix. So it's fairly large, and it continues to be in a country like this where you have a lot of bottom of the pyramid consumers. It continues to be a staple for a lot of consumers in a lot of parts of the country. So that's where we are at, and we will have to nurture that business.
Another strategy that has started to come up is bridge packs. Giving an example, HUL said it introduced a new size between its 10 and 35 rupee Lifebuoy soap, which gives better value for consumers while ensuring affordability and at the same time gives scale to the manufacturer. It is trying to introduce bridge packs across all categories impacted by commodity prices. Although companies incorporate a range of tactics to overcome inflationary pressures, they have no option but to go for grammage cuts for smaller packs so they do not lose out on market share in a competitive segment where significant volumes are dependent on price-sensitive consumers.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Global headwinds and increased input costs are indeed taking a toll on India Inc. In an interview with Business Standard's Nikunj Ori and Arup Roy Chaudhary, the new CII president and Bajaj Finserv chairman Sanjiv Bajaj gave some suggestions on how to deal with this. He said that cutting petrol and diesel duties will spur consumption and demand. Bajaj also said that inflation will continue to hurt margins of companies, but that will not disrupt the revival of private sector capex, which is getting stronger. Let's listen in.
Welcome to this interaction with Business Standard, sir. We'll just start off with a few questions. Nikunj, you can go first.
Firstly, I wanted to ask you, about bank privatization. The government has deferred the plan to privatize public sector banks as the legal amendments have not been made yet. Do you think privatization of PSBs is an idea whose time has come? And also, do you think the RBI should relax criteria to allow corporates, especially with experience in finance business, to participate in the privatization process?
If you actually see the divestment of Air India, moving ahead with the IPO of LIC, these are all clear indications of the government's intent to move ahead with the direction that it provided us on divestment. And we believe that there's no reason to think otherwise as far as divestment of the 2 public sector banks and 1 general insurance company that the government had talked about. As India is going to grow, we need a larger, stronger, deeper financial services sector, which includes bank, which includes insurance companies, asset managers. And it is for the regulators to decide what is the right way to do that. But to build an Atmanirbhar Bharat, we first need an Atmanirbhar financial services industry. I believe the RBI already has a definition of who they would allow and who they would not allow. Based on their experience, I feel that good quality players should be allowed. On the other hand, what is equally important is for RBI to build a discussion around what the future of lending looks like. We are seeing the digital world create significant amounts of disruption and disintegration of what were traditional methods of providing such services. So a discussion on that, I think, is very timely.
There's been some hiccups in the current privatizations that have been privatization of PSUs that have been announced recently, which are Central Electronics and Pawan Hans. So do you think that that process should be strengthened and a rigorous criteria should be in place to screen bidders for other PSUs as well that have been put on block?
So very clearly, you need a transparent, clear, well thought out process and a consistent process that needs to be made. Then you may still have some gaps, you need to correct those. There's no perfect way of doing things. I believe the intent of the government is clear, that government should not be in business, and other than maybe for some critical entities that they would want to control, they are intent on divesting the rest. There is a process that needs to be followed. There are many sensitivities that are involved, so some of these things take time.
What do you think needs to be done more reforms need to be undertaken in the insurance sector per se?
Well, there are multiple things that need to be done. We need to expand banking so that we can increase financial inclusion. Digital banking has shown now that whether you're somebody in rural India or urban India, your aspiration is the same. So how do we meet those aspirations? We have to take banking closer to people, and digital tools can make a very significant benefit. We then have most of our businesses are small and mid-size. And these businesses, we need to leverage them. We need to take capital closer to them. We need, for example, for the export opportunities, for them to build technology capabilities through R&D initiatives between industry and academia. We need, with all the FTAs that the government is signing, we need to make sense of that to them. Because large companies, again, understand that. And we need to see that capital is easily available to them so that they can grow. And then you have the large companies. Large companies, as we are seeing, have built the necessary capabilities where they are known, where they are not only the manufacturing hub for the world, but they want to go out, they want to acquire, they want to build new capacities overseas. So we need a few large banks that can help them strategically do this as well. When it comes to insurance, we have to, for example, insurance as a sector is now, with the private sector, over 20 years old. It has gathered a large amount of assets. How do we put those assets into more productive use? How do we reduce the percentage of assets that have to be put into government securities and move them to funding startups, move them to funding infrastructure projects, move them to creating a solid, viable corporate bond market in India? These things don't happen overnight, but we have to work on each of these norms so that together then we create that firepower that manufacturing India needs to become that manufacturing destination for the world.
Mr. Bajaj, we will start off with your outlook for the FY23, the range that you gave, based on 3 different oil prices. One is oil at averaging $110 a barrel. One is oil averaging $100 a barrel. And one is oil averaging $90 a barrel. So that is 7.4 to 8.2% growth rate. What scenario do you see more likely in this range? Do you think we will be hitting closer to the upper end or closer to the lower end?
So if it stays around $100 level, then I think closer to 8% is what we can look at. Because see, there are things we can tweak as well. For example, while the interest cycle has changed now, what is the amount of interest rate that will go up and how much, how often it happens will also depend on how inflation is on the ground. Partly that is dependent, we know, for the common man on fuel prices. And that's where our suggestion to the government is, in a collaborative manner between the center and the states, for the government to cut taxes right now on fuel. So it helps the pocket of the common man. In addition, the fuel inflation that we have seen, we are hopeful for a normal monsoon at this stage. That should help in abating that as well. Higher MSPs should make a difference. So all this should then help to continue consumption the way it has been in the last few quarters. If at all, there could be a marginal dip over there. But we are still a consumption economy. So I believe that we will see reasonably good growth.
What sort of a magnitude of impact are you seeing India Inc. face in its margin?
No, we are already starting to see it differs by sector, but corporates' margins have got partly compressed, if you see, in the last quarter or two, because input costs had started going up. And that's why you're seeing some amount of passing of that happening, and that's why inflation is also picking up. So you will see some of that happening, and it varies a lot sector to sector.
Mr. Bajaj, thank you so much for your time, sir.
Thank you so much.
तुम इतना डर गए? अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
health and education are indeed the key to a nation's growth, as Sanjiv Bajaj has pointed out. He wants the government to substantially increase the outlay in these sectors. Meanwhile, the government's efforts to tame the country's population have started paying off. Indian women are giving birth to fewer children now than in the past. And this is irrespective of their religion. From 5.9 in the 1950s, when the population control programs were launched, the total fertility rate has now fallen below the replacement level. But what does this mean? Let's find out.
India made history recently. Decades of government efforts to control the population growth are finally showing the much needed result. The total fertility rate, or TFR, which is the average number of children who would be born to any woman in her lifetime, has declined from 2.2 in 2015-16 to 2 in 2019-21. It was revealed in the 5th round of the National Family Health Survey, or NFHS 5, conducted over 2 years starting in 2019. India's TFR of 2 is currently below the replacement level of fertility of 2.1 children per woman. Replacement level fertility represents the level at which a population exactly replaces itself from one generation to the next, thus leading to zero population growth if the level is sustained over a sufficiently long period. This rate is roughly 2.1 children per woman for most countries, although it may modestly vary with mortality rates. Replacement level fertility will lead to zero population growth only if mortality rates remain constant and migration has no effect. Meanwhile, below replacement fertility results eventually in negative population growth and extinction of the population in the long term. Between 1992-93 and 2019-21, India's TFR declined from 3.4 children to 2 children. The TFR ranges from 1.1 children per woman in Sikkim to 3 children per woman in Bihar. 5 states are yet to achieve a replacement level fertility of 2.1 according to the NFHS 5. These states are Bihar, Meghalaya, Uttar Pradesh, Jharkhand and Manipur. All the communities are witnessing a decline in fertility. The TFR for Hindu women was at 1.94 and for Muslim women it was 2.2. The Christian community has a fertility rate of 1.88, the Sikh community 1.61, the Jain community 1.6, and the Buddhist and Neo-Buddhist community 1.39. The TFR among women in rural areas has declined from 3.7 children in 1992-93 to 2.1. The corresponding decline among women in urban areas was from 2.7 children to 1.6. In all NFHS surveys, irrespective of place of residence, the fertility rate peaks at the age of 20 to 24, after which it declines steadily. Another interesting aspect was that the number of children per woman declines with women's level of schooling. Women with no schooling have an average of 2.8 children, compared with 1.8 children for women with 12 or more years of schooling.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Population Foundation of India, a non-governmental organization, said that India's total fertility rate falling below the replacement level is a significant achievement of the country's family planning program, which does not include coercive policies. It said that the findings of NFHS 5 also bust the population explosion myth. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.